You ever stop and think about how our incredibly complex economy actually works? I mean, millions of people all just doing their own thing, and somehow we get everything from iPhones to coffee. For centuries, the go-to explanation has been this powerful, almost magical idea, the invisible hand. But is it really a miracle of efficiency, or is it a myth that just falls apart when you look too closely? All right, let's get into it.
And it all starts right here, with Adam Smith. His idea was pretty revolutionary for the time. He said, look, when you go buy something, you're not thinking about the good of society. You're thinking about what you want. But when we all do that, we're guided by this invisible hand that pushes the whole system toward an outcome that somehow benefits everyone, all without a central planner calling the shots.
Okay, but if that's true, what about the 2008 financial crisis? If the invisible hand is so great at steering the ship, how do we end up with these massive, economy-cratering disasters? It just doesn't quite add up, right? And that's the real puzzle we're going to dig into.
So first up, we need to unpack the theory itself. We'll take a look at the perfect textbook version of the invisible hand, and then we'll see exactly how the real world makes things, well, a lot shakier.
So in modern economics, Smith's big idea gets a fancy name, the first fundamental theorem of welfare economics. All it's really saying is that under a perfect set of conditions, a competitive market lands in a spot where you can't help anyone without hurting someone else. Economists have a term for this, Pareto efficient. It's basically the theoretical gold standard for efficiency.
But here's the catch, and it is a big one. What are those perfect conditions? Well, the theory leans on some massive assumptions. It assumes markets are perfectly competitive, everyone has all the information they need, and, this is the big one, that we all behave like perfectly logical calculating robots.
In reality, of course, those perfect conditions are pretty much nowhere to be found, and that leads to what are called market failures. There are four big culprits here. First, externalities. Think pollution, where the cost isn't baked into the price of a product. Then you've got public goods, like national defense, that everyone wants, but no one wants to pay for individually. Third, insufficient information, like is this food actually safe to eat? And finally, market power. You know, when a monopoly can just set whatever price it wants.
But it's not just about outside forces. A big part of the problem is us. The theory needs us to be rational, but a whole field called behavioral economics has shown that we're really not. We're wired with all these biases, like loss aversion. The pain of losing 20 bucks feels way worse than the pleasure of finding 20 bucks. We also rely on mental shortcuts to make quick decisions, which can lead us to do things that aren't strictly logical. Our brains just aren't the perfect calculators that the theory requires.
So, with all that in mind, let's get back to our big test case, the 2008 crisis. The story you've probably heard a million times is that this was a textbook example of deregulation letting the market run wild. But is that what really happened?
Yeah, the common narrative is super straightforward. Starting in the 80s, regulators were supposedly rolled back, Wall Street was unchained, and the banks went nuts with risky behavior that blew up the whole system. It's a simple, tidy story about greed.
But then you look at the data. A Cato Institute analysis found something pretty surprising. Far from a rollback, spending on financial regulation absolutely skyrocketed. It went from about $190 million in 1960 all the way to $2.3 billion by 2008. That's in constant dollars, by the way. That chart does not look like deregulation.
And it wasn't just about the money. They were writing more rules, too. That same analysis showed the Treasury was proposing over 500 new rules a year in the 2000s. That's up from about 400 in the 90s. So the idea that regulators just vanished, well, doesn't really hold up to the numbers. And what about the poster child for this whole deregulation story, the Graham-Leach-Bliley Act? The narrative says it let risky investment banks merge with boring, stable commercial banks, creating these ticking time bombs. The reality, though, the two most famous blowups of the crisis, Bear Stearns and Lehman Brothers, weren't even part of those big conglomerates. They were just old-school investment banks.
So this all leads us to a much more complicated question. If the issue wasn't a lack of regulation, could it be that the regulations we actually had were part of the problem?
And that's a pretty tough pill to swallow. What if the government's visible hand wasn't just missing in action, but was actually on the wheel, steering the whole system right towards the iceberg?
Okay, let's take a look at the credit rating agencies, Moody's, S&P. The Cato analysis highlights this chain reaction. First, the SEC basically said that for certain investments to be considered safe, they needed a good rating from one of these official agencies.
Step 2. This created a government-approved monopoly for just a handful of companies. And Step 3. Suddenly, these agencies had a captive audience. Their business model flipped from serving investors who wanted honest ratings to serving the banks who needed those AAA ratings to sell their products.
So the result? This massive conflict of interest that led to garbage assets being labeled as super safe. Well, according to this analysis, it wasn't a failure of the free market at all. It was a direct and maybe even predictable consequence of how the regulation was designed.
So far, this has been a tug-of-war between the invisible hand of the market and the visible hand of government. But what if we've been missing a third, absolutely enormous player this whole time? An NBR working paper suggests we have.
Right. The classic debate is always free market versus government planning. But it turns out there's another major way our economy gets organized, and it's happening right under our noses. It's called the visible hand, and what it refers to is the top-down command structure inside a giant corporation. Think about it. When a company like Apple decides to design a new iPhone, that decision isn't made by an internal free market. It's made by managers who give orders. These massive companies are basically little centrally planned economies. And I mean, don't underestimate just how big these internal economies are. Get this, back in 1996, the economic output of General Motors was more than double the entire country of Hungary, and it employed 3 times as many people. These corporations aren't just playing in the market. In many ways, they are the market.
So that raises a pretty fundamental question. Why do we even have firms? Why isn't the whole world just a collection of freelancers trading with each other? Well, this graph from that NBR paper gets at the trade-off. Sometimes, using the open market is cheaper and more efficient. But other times, the top-down control of a single firm, what they call integration, works better. It's all a complex balancing act between things like information costs and who has control.
So, we've got the invisible hand of the market, the visible hand of government, and now the visible hand of the firm, all bumping up against each other. It's a lot. How on earth are we supposed to figure out what the right balance is in the real world?
Well, let's take a classic policy debate. The minimum wage. Simple supply and demand says if you raise the price of labor, companies will buy less of it, meaning fewer jobs. But a super famous study by economists Card and Kruger found that when New Jersey raised its minimum wage, employment in fast food restaurants actually went up. But then, another study by Newmark and Washer used slightly different data from the same event and found the exact opposite, that employment went down. You have 2 groups of brilliant economists looking at the same thing and coming to completely opposite conclusions.
And that really is where this all leaves us. The invisible hand of the market? It's powerful for sure, but it rests on some really shaky assumptions, and it can fail spectacularly. The visible hand of government steps in to try and fix things, but as we've seen, its interventions can create brand new, even worse problems. So the final question isn't really, is the invisible hand a miracle or a myth? It's a bit of both. The real question is, when we're faced with all of these imperfect, shaky, guiding hands, which one do we trust to shape what comes next?